Hello, my name is Seppo Paasonen and I am going to talk about the article Europe's economy not yet on solid ground as business sweats, published at Bloomberg.com on 13th of May 2019 and focus on the graphs presented on the article. The chart titled German Rebound shows the quarter-on-quarter growth of gross domestic product for Germany and Euro area. The purple bars represent Germany and the blue line illustrates the average of the growth of gross domestic product for the whole of Euro area. In 2015, Germany's quarter one was slightly on the negative side, probably due to the Volkswagen emission scandal. During quarters 2 to 4, GDP growth increased steadily, but then peaked on quarter 1 of 2016. Rest of the year was again quite steady, but then in 2017 quarter 1 peaked again. Since then, all the way to the quarter 3 of 2018, the growth has remained about at level 0.5%. Quarter 3 of 2018 was negative for Germany for many reasons discussed in the article, for example weaker demand, weakness in German manufacturing, and increased raw material costs. Year 2019 started positive in Germany according to forecasts, but there's no escaping fresh doubts over global trade, ongoing weakness in German manufacturing, uncertainty over China's growth, Brexit, and the possibility of the trade war extending to Europe. Euro area started year 2015 stronger, but since then has been following the same trends of Germany quite closely. This is to be expected since the same phenomena, for example migration crisis, protective trade politics, and Brexit, have affected most European countries, and because Germany accounted for 28% of the Euro area economy in 2017. According to the article, GDP of Euro area increased by 0.4% in the first quarter, and economists currently forecast total growth of 1.1% for 2019, which is less than half the pace of the United States. Sustaining the upturn would require a significant improvement in confidence to help investment and demand. The next line diagram titled Downward Trajectory, published by the European Commission, describes the economic sentiment in the Euro area and Germany. The two lines follow the same trends quite closely, Germany's red line staying a little bit higher all the way. The sentiment index increased quite steadily all the way from 2013 to the end of the year 2015. The sudden drop at the beginning of 2016 could be, for example, due to the market interest rate hike made by Fed, indicating that the economy of the United States is once again sound. The index quite quickly started a new upturn and reached its top at the end of 2017. Since then, the sentiment index has decreased at the same pace it increased before, reaching year 2016's level. Volatility in financial markets and rising uncertainty over global growth are the only obvious reasons for the big decline. A quick upturn does not look likely because of the recent events of trade war between United States and China. Furthermore, Europe is undergoing several political and social instabilities, appearing as arguing governments and even violence, like seen in France. European Central Bank holds its next policy meeting in early June to determine the terms for new loans and judge if the economy needs more stimulus.